So what if I told you I have an option strategy that make you the full amount of profit if the stock went up, went sideways, or even went down a little bit? Introducing put credit spreadsheet. We will start by explaining what it is and how it works, and then look at 4 put credit spreadsheet that I have open right now in my account, and finally take a deep dive into my Tesla put credit spread that I have open on February 28th, and what I did when the Tesla stock took a deep dive and went down and the put credit spread went deep into the money, and how I was able to roll it over into my advantage, and I just closed a few days ago for a big profit. Let's dive in. Put credit spread is when you sell a put and then simultaneously buy a put deeper into the money, resulting in a credit from that trade. Your maximum win and maximum loss are already predefined from the start. The maximum win will be the credit that you are receiving for selling this put credit spread, while the maximum loss will be the width of the spread minus the credit you already collect. So let's take a quick example on Microsoft, and that will help you understand how put credit spread work. So if we went here to the August 16 and we said we are going to sell a put for 440, and then we are simultaneously buying the put for 430. Selling the put for 440, meaning we are willing to buy Microsoft stocks for 440 by August 16. While simultaneously we bought the put for 430, meaning we have the right to sell Microsoft for 430 from this day, from the day you buy the option until August 16. The width of the spread is $10 multiplied by 100 shares, resulting in $1,000. We are collecting $297. That's mean our maximum loss will be 702. So I removed my camera so you can see the spreadsheet here. You can see since I sold the put credit spread deep in the money, I collected less than half the amount. Since we are risking $10, but we are receiving only $3 or almost $3. And why is that? Because I chose to sell deeper in the money, giving me protection to the downside. So if we change it here to break even, you see the stocks will have to go down about 4.5 before it start getting into the money and we start losing money or reducing our maximum potential profit. If you went under the 430 by that day, then we are going to lose the maximum loss for this trade. But if it end up anywhere above the 440, we are going to get the maximum win. Of course, since we received about $3, that's mean our break even will be the 437. And you can see on the diagram here, 437.02, which is minus 3.10 from the current price. You can see here the maximum loss, the maximum win. And then after that, it doesn't matter in the put credit spreadsheet. Even if Microsoft went to 0, we are still just going to lose the 700. And the opposite is correct. Even if the stock went up to 460 or above, we are only going to make the credit that we receive, which is in this case is almost 300 or 298. Of course, you can make any put credit spreadsheet as long as you follow the same rule. For example, if we said we are going to sell the 460 and we are going to buy the 440, we are selling a put for 460, even that the price right now is 451. So it doesn't give us protection to the downside. However, because of that, we are getting a higher credit. So we sold here the 460 and bought the 440 as protection for the downside. That's mean we are right in the middle. And sure enough, we are going to receive 910 credit for risking a $20 or $2,000 per contract. You can see here that the break even is about the current price right now, which is going to be 450. The maximum loss for this trade will be at 440 and below. And then the maximum win for this trade will be for 460 or above. So you get the idea now. You can choose any 2 prices that you want. Just make sure that you are selling the higher put and then you are buying the lower put to act as an insurance for you and to limit your losses. And in the same time, it's limiting the amount of capital that you need to invest in that stock. Let me take you ahead and show you some of the put credit spread that I have in my account and how is it performing. So here you can see on Google, I have a put credit spread to buy for 120 and sell for 100. I have opened it on December 23 and expire beginning of next year, January 17, 2025. So it's a leap. It's about 13 months to expiration. I have received an average credit of 360 per contract, and I have opened 2 contracts here. Since Google stocks have been going up, as you can see currently, in order to close it, I can pay about $34 per contract. You can see the unrealized gain is 90%. Absolutely great. And that generated 652. If we scroll down here, you can see the details for this Google put credit spread. Let's jump to the next one. The next one is Tesla. I have 150 over 100, meaning we are selling the 150 put and buying the 100 put. Right now, it's worth 767. If we scroll down, you see I opened it on January 24 of this year, 2024, and it expired in January 17, 2025. So it's also 1 year. I have received an average credit of 11.37. You can see the unrealized gain right now is 32%, which is 1,110. And if we go to the history here, you will see the detail. The first put credit spread was on January 24. I received 807 credit. And here I have opened a second one for 1,100. On March 6, I opened a third one for 1,261. But that was really just a quick trade. I went back and closed it for 12.20, making a tiny profit between the two, just $41. You can see here I have opened the last one was for 1,300. And that's how I end up with the 3 open put credit spreadsheet on Tesla. It's positive right now and I intend to keep it until expiration date, or if I got a really great opportunity to close it for small credit, and that will allow me to release my collateral early, and then I'll be able to invest it in another name, or maybe just selling a new put credit spreadsheet on Tesla. Let's jump to the next name. Here we have Netflix, 350 over 300. I have opened it in September of 2023, expired January 16, 2026. So it's really 2 years in this case. As you can see, I received a great credit, 16.79, where right now the average to close it is 2.48. But it's not really accurate since the bid and ask spread is very big. And that's mainly the reason why I couldn't close it so far. As you can see, the unrealized gain is 85%, which is 1,431. Amazing return. If we go down to the history, you can see here the details for that trade. This is the only option right now that is working against me. If you see the details, I have opened it on April 5th and it's expired the beginning of next year. I have received $306 per contract, and right now is $476 to close since the stock did drop since that time. So I have an unrealized loss of minus 55 or minus 510. However, I have still plenty of time for the stock to go my direction, so I'm not worried about it. I'll just wait patiently. You can see here the details when I open the put credit spread on Intel. Let's go ahead and take a deep dive into my put credit spreadsheet that I sold on Tesla on February 28 and compare the put credit spread versus just selling a put, also known as cash secure put, versus just buying stocks and investing in the stock of the company. So in this example, we are going to work with $19,000, and you're going to know why in a second. So first, if we want to use the $19,000 to buy Tesla shares, since the stock at that time was 202, that will result in a 94 shares. Since the shares has no limitation, it has unlimited maximum win, since it can theoretically just keep going up. And same for the percentage return on your capital investment. In this case, it will be unlimited. The more the stock will go up, the more percentage return will come to you. Now, in the second scenario, we are going to sell a put of 190 on Tesla stock. So even though the stock was at 202, we are trying to give ourselves a little bit of small protection to the downside. We sold a cash secure put on Tesla that expired on March 15. That's about 3 weeks. You can see that the capital requirement will be $19,000. The maximum win in this case will be 239, and the percentage of return on our capital will be the 239 divided on the 19,000, resulting in 1.25% in 3 weeks. So it's less than a month, so it's not bad. So this is the trade that we did. As you can see here, the Tesla put credit spread that I sold on February 28, it's a put credit spread, But in our case, we can just assume that if we sold just the put, this is what it would have cost us, which is inaccurate since this is actually what I paid for as part of my put credit spread. So as you can see, I sold Tesla 190 put that expired on March 15, and that was at February 28, 7:39 a.m. It gets filled at 2:39, which is the same amount we are using in the spreadsheet here. So finally, let's talk about the put credit spread. We are selling here the 190 put, and we are simultaneously buying the 180. And this is exactly what you see here. I sold the 190 for 239 of credit, and then I paid a debit of 86. Since it was simultaneously, I have collected 153 credit to my account. That was my premium, and this is my maximum win in this case. So if we see here, the capital requirement here, this is the amazing part, is so much smaller. The capital requirement is actually 1,000 minus the credit that you instantly receive from opening this put credit spread, which is 153, resulting in 847. That is your total investment amount in this case. The maximum win in this case is the 153, which is what you received from the put credit spread. It's a little bit smaller than just selling the put because we are buying this 180 put to protect us to the downside. The lastly is the percentage return on your capital. As you can see, it's 153, the lowest compared to the other two. However, because the investment amount is the smallest in this case, it's only 847, the percentage will be 18% in just 3 weeks. That's amazing. Fast forward in time, on March 15, Tesla stock dipped hard all the way to 163. So obviously, as you can imagine, that was a big hit and a big loss for me. So let's take each scenario what's going to happen. In the case of the stock, as you can see, since the stock dropped down from 202 to 163, that's a 39 drop per share. Multiply by 94 shares, resulting in a minus 3,666 will be your loss if you would have bought the 94 shares. Now let's jump to the second scenario, which is selling a put, or also known as cash secure put. In this case, we are buying for 190, even though the stock price is 163. That means we are losing $27 per share or $2,700 per contract, minus the credit that we collected previously, the 239, resulting in minus 2,461. A smaller loss than just owning the stock, but it's a loss nonetheless. Let's take the third scenario, the put credit spread. Well, in this case, the maximum loss is the width of the spread, meaning we are going to buy the share for 190, but we are simultaneously selling it for 180. That's a $10 per share loss. So it will be a $1,000 loss minus the 153 credit that we collected from selling this put credit spread, resulting in a minus 847 loss. So on March 15, I was put in a position where I have to either take this loss or try to find a way around it. I didn't want to take the loss, so I decided to roll over my position. So what I did, I went ahead and I bought to close the 190 Tesla that expired on March 15 for $2,063. Oof, ouch, it's a big amount. And then I simultaneously sold the 180 for June 21st for $2,208. So as you can see, it's a little bit bigger than what I'm buying for, and that will result in a credit. So this is rolling over for a credit while simultaneously reducing my obligation from buying for 190 to buying for 160. So I collected a credit of 145. And at the same time, since I had the 180, which was in the money, I went ahead and I sold to close, and I collected $1,075. However, because I didn't buy a protection for the downside, I changed it to a cash secure put. I had to raise my cash invested, in this case, from the 847 all the way to the 1800, since right now I'm selling in 180 cash secure put. So I rolled from 190 to 180. In the case of stock, nothing would have happened because if I don't want to take the loss, then I will just keep holding the stock. But in the case of the put, then I would have collected $145 from the rollover, meaning my potential win will be the 145 plus the 239. But in the put credit spreadsheet, since I was able to sell my insurance, the 180 for $1,075, that raised how much I collected. So I collected the 145 from the rollover plus the 1,075 from the 180, resulting in 1,220. Fast forward in time to June 21st. The stock rebounded a little bit, but it did not reach the 202, which is where I started. So at this point, it was 183. If we just own the stock and nothing more, we would have been still down $19 per share. Multiply that by the 94 shares, resulting in a loss of 1,786. And if you look at the percentage, we will be down minus 9.4% for what? For holding the stock for 4 months. Not nice at all. Let's go ahead and take a look at the put. In this case, since we change our obligation from buying from 190 to 180, so since it's expiring at 183, that means it's expiring out of the money. Yay! So in this case, your profit will be the 239 that you collected at the start plus the 145 for the rollover, resulting in a 384. And then if you take that and divide it on the 19,000, percentage-wise, you made 2%, but it's 2% up. It's much better than 9% down, right? Finally, let's take a look at the put credit spreadsheet. Similarly to the puts, since we have an obligation to buy for 180 and it was 183, it expired out of the money. But in this case, we collected more premium thanks to the 180 that we sold. So in this case, the 153 that we collected originally plus the 1220 that we got from the rollover will result in 1,373 profit. If we took the 1,373 divided on the 19,000, that will result in 7.22 return on our investment in 4 months. Not the best, but also not the worst. We change a loss from minus 847, which is a complete loss for the full amount that we invested at that point, to a win of 1,373 or 7.22 on our capital investment. I'll take that any day, Not every day that the stock will go against you. That's mean in other scenarios, you will collect even a higher return, maybe the 18% that we were talking about. If the stock just continue up, stay the same, or went down, but just a little bit. Like in this case, if it just went down from 202 all the way to 190, 191, we still collect the full credit in the put credit premium. That is the beauty of it. So this is the final result. As you can see, this is an actual example that happened to me. Let me show you the rest of the Tesla option. So during this time, by the way, the Tesla did drop significantly. Like after I roll it over, if we go back to Tesla shares, let's look ahead here. So as you can see, we rolled over at March 13. If we take a look at Tesla on March 13, this is what it was, about 169, the average for that day. And then after that, on March 15, it was 163. That is the official date that these options would expire if I haven't rolled over. The Tesla shares dipped all the way to 142, which was painful. I really believed in Tesla. I didn't care, and I actually doubled down by selling a new put credit spread, like you can see here. So as you can see here, I sold the 150 and I bought the 140. Even this one, it went down into the money deep. But then later it rebounded when Tesla rebounded, and then I was able to close it here for $8, leaving me with a profit of 252. So going back here, you can see these are the full details for the put credit spread and comparison for a put, or like we call it cash secure put, and comparing it to the stock. You can tell that really you can use the option to give you an advantage. You can see here, if you invested the 19,000 for an unlimited gain and unlimited percentage, you might end up with a higher return if the stock went up, and nothing but up. But unfortunately, that's not the reality that we live in. Here, I sold a put for a limited potential profit. However, at the end, I end up with much better result than going for the cash secure put or going for the stocks. I hope that explained put credit spread for you and encourage you to use it in a wise way. I don't recommend selling a put credit spread out of the money, even if you think the stock will go up. I will just advise you to buy calls on that name either leap calls, or you buy like a poor man cover call. You buy deep in the money and sell a call against it just to collect premium while you're waiting for the stock to go up. Just selling a put out of the money will be a little bit more riskier, just in case the stock went down. You don't have any protection to the downside in that case. If you find this video useful, please give me a like, hit the subscribe, and maybe leave a comment. As always, the information provided in this video is for educational purpose only and should not be construed as a financial advice. Investing involves risk, including the potential loss of principal. If you haven't checked my poor man cover call and my cash secure put videos, you should watch them next. I will link it to this video. Thank you guys. Have a good day.